Picture this, a financial behemoth, a titan of Wall Street, teetering on the brink of collapse. Morgan Stanley, a name that has been synonymous with financial prowess and blue-chip deals, was once on the verge of extinction. But how did it find itself on such shaky ground? Let's take a step back to the Great Depression. It's the early 1930s, a time of economic turmoil and uncertainty. Yet, in the midst of this chaos, Morgan Stanley was born. Founded by Henry S. Morgan and Harold Stanley, the firm quickly rose to prominence, solidifying its place as a pillar of global finance. Over the decades, it became known for securing blue-chip deals and cultivating a reputation of sophistication and success. It was, in every sense, a Wall Street titan. Fast forward to the early 2000s. The world economy was thriving, and so was Morgan Stanley. But beneath this veneer of prosperity, cracks were beginning to form in its seemingly impenetrable foundation. The firm, like many others, was riding the wave of a booming housing market, blissfully unaware of the impending storm. The year 2007 marked the beginning of a global financial crisis, a crisis that would shake the very core of the world's financial systems. And Morgan Stanley, despite its titan status, was not immune. But the signs had been there, lurking in the shadows. There were warning signals, indicators that the firm's foundation was not as solid as it appeared. It was like a majestic iceberg, with its true vulnerability hidden beneath the surface. So what led to the near collapse of this Wall Street giant? How did a firm, once considered unshakable, find itself on the brink of disaster? It wasn't just a single mistake or misstep. It was a series of risky decisions, a gamble that would ultimately backfire. But what led to the near collapse of this Wall Street giant? Let's dive into the risky gamble that backfired. As we delve deeper into the story of Morgan Stanley, we'll uncover the lessons we can learn from its near demise, and how we can use these insights to navigate the unpredictable world of investing. The year 2008 was marked by a dangerous game of chance, the subprime mortgage gamble. To understand this gamble, we first need to grasp a concept known as mortgage-backed securities, or MBS. Imagine a bundle of mortgages. This bundle is then sold to investors, who receive income from the mortgage payments. It's like owning a small piece of a large number of mortgages. In theory, as long as people keep paying their mortgages, these investments are sound. Now let's talk about Morgan Stanley. They were a big player in this gamble. They bought these MBS, investing heavily in the housing market. You see, they were betting on the housing boom to continue. The higher the house prices, the more valuable their MBS investments would become. It was a high-stakes bet, but the potential rewards were enticing. So what could possibly go wrong? Well, what if the housing market didn't continue to boom? What if it went bust instead? These were the questions that some were starting to ask. But at Morgan Stanley, these concerns were largely dismissed. The executives were confident in their strategy. They believed in the robustness of the housing market. They were convinced that the boom was not just a bubble but a long-term trend. But here's the thing about bubbles. They always look solid until they pop. And the housing market was much like a bubble, inflated by over-optimism and, some would say, greed. The dismissal of risks by Morgan Stanley's executives was a classic case of hubris. They were so confident in their strategy, so certain of their success, that they ignored the warning signs. But as we now know, they were wrong. Dead wrong. The housing market was not a sure bet. It was a bubble, and like all bubbles, it was destined to burst. And when it did, those mortgage-backed securities, those seemingly solid investments, turned out to be not so solid after all. The stage was set for a financial disaster. The house of cards was about to collapse. Like a ticking time bomb, the market shift revealed the toxicity of the mortgage-backed securities. The turning point was like a roller coaster losing its track at the peak. Suddenly, the housing market, which had been booming, was not so attractive anymore. The housing bubble had burst and the market was plummeting, taking Morgan Stanley's investments with it. When the dust settled, it was clear that Morgan Stanley had made a gamble that didn't pay off. The losses were significant, to say the least. The financial titan's balance sheet was shrinking at an alarming pace. It was akin to watching a mighty ship, once unsinkable, being swallowed by the sea. The stock price of Morgan Stanley was spiraling down, like a plane caught in a tailspin. Investors watched in horror as their investments evaporated into thin air. The Wall Street giant, who had once seemed invincible, was now on the brink of collapse. The whispers of bankruptcy started to circulate, turning into loud conversations, then into a deafening roar. The atmosphere was charged with panic. The thought of Morgan Stanley filing for bankruptcy was unthinkable. Yet that was the reality facing the financial institution. The executives were in panic mode, desperately trying to salvage what they could. Deals were made in haste, decisions were rushed, all in a bid to keep the company afloat. It was like watching a train wreck in slow motion. You knew what was coming, but you couldn't look away. The magnitude of the situation was overwhelming. The once mighty titan of Wall Street was on its knees, struggling to survive. In the face of imminent downfall, a question arose. Was Morgan Stanley too big to fail? This was a question that would not only determine the fate of Morgan Stanley, but also have lasting implications on the financial industry and the economy as a whole. The answer to this question would set a precedent for future crises and change the way we view financial institutions forever. Opening, the government was left with a dilemma: let the giant fall or intervene with a controversial bailout. As the financial turmoil set in, the US government found itself facing a momentous decision. The question on everyone's lips was simple yet complex. Should they let Morgan Stanley, a Wall Street titan, crash and burn, or should they intervene with a controversial bailout? On one side of the debate were those who argued that letting Morgan Stanley fail could trigger a systemic collapse, a financial domino effect that could devastate the economy. On the other side were those who pointed out the moral hazard of such a bailout. They argued that rescuing such a financial institution would merely incentivize reckless behavior in the future. If big banks knew they could gamble with impunity, safe in the knowledge that the government would always bail them out, what would stop them from making the same mistakes again? The government, however, had to consider more than just the philosophical debate. It had to think about the practicalities. The bailout would not be cheap. It would involve a significant amount of taxpayer money. The exact figure? A staggering $80 billion. Yes, you heard that right, $80 billion. This was not just a financial decision, but a political one. How do you justify using public funds to rescue a private institution that had, in many ways, contributed to its own downfall? How do you explain to the ordinary taxpayer that their money was being used to bail out a Wall Street giant? In the end, the government chose to intervene. It was a decision that sparked controversy and debate, a decision that still has repercussions to this day. But at that moment, it seemed like the only viable option. The potential consequences of allowing Morgan Stanley to fail were just too catastrophic to contemplate. Closing. The bailout marked a turning point, but what happened next? What did Morgan Stanley learn from this crisis? In the aftermath of the crisis, Morgan Stanley had to face a new reality. Their near collapse forced a transformation, a metamorphosis from reckless risk-taking to cautious conservatism. New regulations were put in place, acting as guardrails against the financial brinkmanship that had brought them to the edge of ruin. But the story doesn't end there. The aftershocks of the crisis reverberated through the financial world, offering valuable lessons for everyday investors. It was a stark reminder of the importance of due diligence. The belief that bigger is safer was shattered, reinforcing the need for investors to understand the underlying assets and risks of their investments. It underscored the perils of relying too heavily on a single sector, in this case, the housing market, and highlighted the importance of diversification. The crisis also laid bare the folly of unchecked optimism. The assumption that housing prices would perpetually rise was a dangerous illusion. It served as a reminder to question prevailing market sentiments and to remain skeptical of investments that seemed too good to be true. However, despite these lessons and new regulations, risk factors are still present in the market. Financial institutions continue to engage in complex transactions that are difficult to understand and regulate. The lure of quick profits can still lead to imprudent risk-taking. The financial system remains interconnected, meaning that the failure of one institution can potentially ripple throughout the economy. In the end, the story of Morgan Stanley is not just about one bank's near collapse. It's a case study in financial hubris, a cautionary tale about the dangers of unchecked optimism and unregulated risk. The crisis taught us that no institution, however big, is immune to downfall. It's a reminder of the dangers of hubris, greed, and short-sightedness on Wall Street.